Forbes is the nation's leading business magazine, a circulation of 900,000. The editions reach a worldwide audience in many different languages around the country of more than 5 million readers. He is the author of Flat Tax Revolution, using a postcard to abolish the IRS. That's something we'd pass in an overwhelming vote if we could vote on it here. And he has another book called A New Birth of Freedom. Well, it's our privilege to hear Steve's thoughts tonight. He's looking ahead. He understands where America ought to be going. He understands how to get from here to where we'd like to end up. And after his comments, Pierre and I are going to present him with the Individual Freedom Award for 2009. So please join us and welcome Steve to Delaware, and congratulations on getting the award. There you go. Thank you. You got it.
Well, Governor, thank you very, very much for those very kind words. And Pierre, that was a fantastic introduction of your father. I wouldn't risk it with my kids. We believe in entrepreneurship, but you got to draw a line somewhere, risk-taking. But it is good fun also to see many friends again. I think Delaware is a fantastic state. As Pete mentioned, I did win the primary here, so I think this state is full of geniuses. So you can applaud yourself, why not? But Pete also outlined why we're in this extraordinary period, because never before have we had an administration and a president, to be blunt, that is hard left as this one. And who knows, it may change over the next few years. People in the Oval Office do many times change, but right now they have a very bold agenda, and in the midst of an economic crisis, it is one they think they can at least get part of it through. And so to get this award tonight at a time like this is a wonderful honor, signal honor. One appreciates most what one deserves the least, and in these hard times, getting a free dinner thrown in with it is too good to be true. But the fact of the matter is, the problem with the economy today is not free enterprise, American-style capitalism. The problem that brought us to this state is government mistakes, not that of capitalism. Pete has outlined their bold agenda, what they want to do, whether it's health care, and that is going to be the big battle this year, energy taxes, forced unionization. The other day, the president made it clear to bank executives that they were not going to be allowed to pay back their TARP money before he gave them permission. He called them to a meeting to the White House to show where they stood in his estimation. They were served, according to some participants, a single iceless glass of water, not to be refilled, and made it very clear that he didn't think they should pay back the TARP money, because he said it's like an antibiotic. You may feel better, but you've got to still take the medicine for a while. Now that tells you something when, having given out taxpayer money, the government wants to bar you from repaying taxpayer money. I don't think this has ever happened before in human history. And when the American people learn more and more about this, I think they're going to pull back and say, we love the guy, but we don't love his policies at all. And the other day, the president talked about where we've sinned for a while, we are in an era of sacrifice shareholders. He said stockholders have to make sacrifices. Well, as somebody pointed out, a 55% decline in the stock market might qualify as a sacrifice. And then the binge spending. I mean, tripling the national debt, spending more than 43 presidents put together. Now, among us, one of the biggest disappointments of the previous administration was the refusal to really hold the line on spending. It's been compared to drunken sailors, which, as you know, is an insult to drunken sailors, because they're spending their own money, not taxpayer money. So this does get to why we have this crisis today. What in the world went wrong? Because it wasn't a failure of capitalism, it was a failure of government. And to put things in perspective, from the early 1980s, after Ronald Reagan did nationally what Pete did here in Delaware, and I just can't get over those numbers that Pete cited, 19.8% state income tax rate 30 years ago, not national, state. And to get it down below 6, having set that pattern in motion, his successors kept it down to where it is eminently reasonable, unless it gets raised again. Hello, don't do it. We're doing it in New Jersey. You'll get our wealth if you just keep it low. But what happened, put it in perspective, from the early 1980s to the summer of 2007 when this crisis hit, the United States and the world went through one of the most extraordinary eras in human history. Never before had so many people in so many parts of the world advance so quickly economically as happened in that quarter of a century. Literally, upwards of 70 million people a year joining the middle class around the world. We all know about India and China, but Central and Eastern Europe, that region as a whole, had growth rates higher than the Asian region. Many countries in Africa, even before the commodities boom, were starting to grow at 5–6% real growth rates. Parts of Latin America, we all read about the lunatic running Venezuela, but other countries were getting their act together, like Colombia, once seen as a failed state 15 years ago, was starting to really boom economically. And the United States, some of you are old enough to remember Rodney Dangerfield getting no respect. But even the U.S. got things somewhat right, despite all of the abuses. Between 2003 and 2007, when the crisis hit in that 4.5-year period, the growth, the expansion of the U.S. loan, just the expansion alone, exceeded the entire size of the Chinese economy. We grew the equivalent of China in 4.5 years. Now, clearly, their growth rates have been higher, but they're coming off of a much smaller base. So what in the world went wrong? Because after all, in the summer of 2007, if you looked at the bad loans, the prospective bad loans when this bubble burst on bank balance sheets, they were really no worse proportionately than what was on bank balance sheets in this country 20 years before. Remember the late 80s, early 1990s? You had the whole savings loan industry collapsing. Banks were loaded, especially the large ones, with Latin American loans, commercial real estate loans. So why? We had a real crisis then. We had a recession, but nothing like what we have today, and no crisis that threatened the financial system of the United States and the world. To understand what happened, we have to understand how this crisis came about. And then I think it becomes clear where we have to go from here. It began, I think, around 2003, 2004, when the Federal Reserve made a fateful miscalculation. The Federal Reserve thought we were going to be like Japan in the 90s, go through years of stagnation, and so they felt it incumbent that they had to print a lot of money, keep interest rates at artificially low levels to keep the economy moving. Well, the economy was much stronger than anticipated. They have no business trying to manage the economy. That's for others. American people do it rather well if they're allowed to. But in 2004, they printed a lot of money. Now this gets to, and I know it's dinner time, after dinner, kind of full, especially if that dessert, and eyes get a little heavy, but we have to deal with one of the most boring subjects in the world, Federal Reserve monetary policy. It's truly a dull subject. You hear their chairman testify on the Hill, and you know why it is the institution that it is. And just a tip to some of you, if you ever find yourself in an airplane, in coach, middle seat, on the runway, watching your life pass away, you want a little bit of elbow room? Just talk to your seatmates about monetary policy. You'll have all the room you want. If any of you are single, or you have kids or grandkids who are single, on a bad date at a deadly dull dinner party, you want to somehow get out of it gracefully, start talking about monetary policy, and the rest of the evening will be yours. You'll never see those folks again. But it boils down to an automobile, truck, whatever it is you drive. You can have a magnificent vehicle, but if you don't have sufficient fuel, stall the engine. Too much fuel, flood the engine. Just the right amount, you have a chance to move ahead. Same is true of monetary policy. If the Fed doesn't create enough money, you can have an economy with real strengths, but you're gonna stall it. If you put in too much, get the equivalent of flooding the engine, inflation and other distortions. Just the right amount, you have a chance to move ahead. Well, in 2004, they started to flood the engine. The first thing that happens, especially the Federal Reserve, the dollar, like it or not, the dollar is the global currency. It is the reserve currency of the world, and when we mess up, it not only hits us, it hits everyone around the world, one way or the other. But when you start printing too many dollars, and we should have learned this from the 1970s, you print too much of a currency, the first thing that flows into is the commodities market. Usually commodities are all over the place, some up, some down, some treading water. When they all go in one direction, something is happening. So what happened in 2004? Suddenly they all shot up. Oil went up, copper went up, lumber went up, cattle went up, steel prices went up, shipping rates went up, heck, even the price of mud went up, everything went up. And people are wondering what in the world is going on. It must be India and China, or it must be those evil oil company executives. These people have been in business 130 years, but they're dope, slow learners. They finally learned how to manipulate oil markets after a century and a half. Finally did it. But in the 1970s, you read the same kind of stories. You know, they're parking tankers offshore to manipulate the markets. But it was a classic inflation. And we also have a lot of money around. It also flows into other areas. And where did it flow here and some other countries? Housing. Already in 2004, housing was already booming in the United States, thanks to a tax law change made in 1998, which virtually exempted a large part of your primary residence capital gains from taxes. Your couple, first $500,000 if you sold your primary residence, was now exempt from capital gains taxes. So if you look at the price increases before 1998 and post-1998, you notice a sharp difference. So by 2004, this was already a booming market. And people figured, housing always goes up in price, right? It's somehow written in the Constitution. It must go up each year. And so people figured this was a no-lose business. Money started to really flood in. Because after all, even if a borrower defaulted, so what? The housing would go up. So lending standards went down, and they invented a new mortgage. The new mortgage was, why have an income? Why make a down payment? Why pay interest? Why pay principal? They call it negative amortization. And then you had a compounding of this felony with Fannie and Freddie, what they call government-sponsored enterprises. Implicit guarantee of the U.S. government so they could leverage up in a way not even Wall Street in binge days could do. So in a period of 2 years, they guaranteed over $1 trillion of junk mortgages. So this thing went haywire. Standards went by. So no surprise, at some point, bubbles burst. And in 2007, this one burst. In the summer, actually August, really exploded. Prices were going down before then, but it seized the financial markets. Thanks to securitization, which means bundling securities together, assets together, and then chopping them up, selling them all around the world, spreads the risk in and of itself. Securitization, good thing. But what it meant, though, was this stuff went everywhere. All banks around the world had this stuff, and many for months afterwards didn't know how much of it they had. Heck, you go home tonight, look under your couch, you'll probably find a subprime mortgage still floating. It just went everywhere, everywhere. And so, the system had its first seizure. People didn't know who was on the other side, how much of this stuff did they have. And then the government decided, let's compound these errors even more. Now this gets to another boring subject. Take a sip of your cold coffee if you still have some. This goes to accounting. What they call mark-to-market accounting was banned in the U.S. in 1938 because it was destroying banks gratuitously. But bad ideas, some of us discussed earlier, never die. Came back, started to emerge in the early 90s, became writ in 2007. Now, mark-to-market accounting means you're supposed to mark assets down to their market value, or up to their market value. That's good for mutual funds and things like that. But for regulatory capital of institutions that are regulated, like banks and life insurance companies, it is insane. Capital for banks and insurance companies is supposed to be stabilizers, reserves, cushions, adequacy. It's not supposed to be a day-to-day trading thing. It's supposed to be quite the opposite. Instead, they treat it like a trading account. So think of it this way. What would be the value of your home if you had to sell it in the next half hour? You wouldn't get very much for it. Yet what the regulators and auditors, fearful of lawsuits, started to do to banks and life insurance companies was to say, mark down the value of your regulatory capital, even if the loans are money good. Remember, on the subprime mortgages, over half are still making payments. If you do a cash flow analysis, amazingly, this stuff is probably worth 50, 60 cents on the dollar still. And yet the regulators said, knock it down, knock it down. And so what did that mean? When you do have to knock down your capital, you have to raise more capital, which means you have to raise more money through the equity markets. It means your stock goes down. You get in a death spiral. And so mark-to-market accounting was pro-cyclical instead of counter-cyclical. It made cycles worse, not better, instead of smoothing them out. So that's an insane thing to do. And then what happens if you have no market? Makes it even worse, because then bottom is zero. So you have, it just fed on itself. Absolute disaster. And that's why you have most of those losses, now almost $1 trillion of losses. Do you realize most of those losses are book losses, artificial losses, not actual cash losses? Do you realize today banks have more cash on hand than they've ever had in their history? If you compare American banks, what they had in cash before Lehman Brothers was allowed to go under in September, it was about $250 billion, kind of a constant number. Today, banks have over in cash $600 billion. And yet the system has seized up. Yes, it's beginning to thaw a little bit, but bond markets, if you're less than AA, AAA, tough. Spreads are still wide. Refinancing mortgages, good luck. Some banks will do it, others will make it extremely difficult. So that's like the heart. This is a financial crisis. You can have magnificent muscles, great brain, but if the heart's not working right, you got a problem. Economy can be strong, but if the credit system's not working right, you got a big problem. So even compound, and if, by the way, if you love mark-to-market, if you love to know what your house would be worth, you had to sell it in 10 minutes, put in a footnote if that kind of stuff interests you. Distressed prices. There's a huge difference, as anyone who studies finance can tell you, between an asset held to maturity and how an asset in a dysfunctional market sold at a distressed price. Basic difference. And yet the regulators, until very recently, refused to recognize it. And then short selling. Short selling has a proper role in finance, but the fact of the matter is the SEC decided they had to join the fun. Now, from the Great Depression until 2007, the rule on short selling was you had to wait for the stock to go up in price before you could sell it, called the uptick rule. This was after the devastating bear raids of the Depression. Been around almost 70 years. SEC repeals it in July of 2007. Maybe it's just a coincidence, but it became markets almost, volatility exploded after that. And then the SEC, and this sounds X-rated, decided not to enforce the rule against naked short selling. You know, in short selling, you're supposed to borrow the shares and then sell them. Well, why bother to borrow the shares? Just call up and say, sell 10 million shares of GE or DuPont. You own the shares? No, just sell them anyway. Nice. sell more shares than exist for an equity. It's like calling up a realtor and saying, sell my neighbor's house. Do you own it? No, just sell it anyway. Just sell it. I'll try to buy it back later. It was insane. It just was nuts. So you put all of that together and you turn what would have been a serious crisis, would have been real consequences, real losses. A lot of CEOs would have walked the plank on this, into a systemic disaster. And once you understand how this crisis came to be, and this does not excuse what happened on Wall Street, some of the excesses, but without the Federal Reserve making its mistakes and these other mistakes, this bubble could never have reached the size that it did. If government had been doing a job, this thing could never have unfolded the way it did. So what should be done now? Well, just last week they made some modifications of mark-to-market, not as far as I would like to go, but hey, take what you can, and that's why the markets went up 3 weeks ago in anticipation that this was going to come to pass. Tomorrow the SEC is supposed to do something on short selling. And there the immediate thing that has to be done is the Federal Reserve. Now, in a crisis like this goes back to the 19th century, 150 years ago, a fellow named Walter Bagehot, the Economist newspapers they call themselves. It's a magazine, but Brits love to do that with just a newspaper. Maybe not right now, given the state of newspapers, but anyway, Walter Bagehot wrote about what a central bank is supposed to do in a bank panic. They're supposed to pump out money, properly secured, to prevent the system from collapsing. And then when the crisis passes, they unwind those positions. Very basic. So the Federal Reserve, despite its reputation of throwing money all over the place, even more than the new administration is able to do, the Federal Reserve actually has tightened up since December. Since December, it has withdrawn $400 billion from the financial system at a time when it's been on unprecedented stress. This is truly nuts. Now, in the last 3 weeks, they've started to ease up again, but it's equivalent to a fire department rolling up the hoses when the house is still on fire. Maybe they're worried they're going to get the, water stain the furniture or something. But it's bizarre. At a time when credit's being extinguished, I hate to keep throwing numbers, but it's important, $40, $50 billion a week. The Fed's only creating now $30 billion. You still have what they call deflation. People are selling assets not because they want to, but because they have to raise cash. They don't know whether they're going to be able to roll over their loans. And so with short sellers, knowing they can knock these stocks down to oblivion, it becomes a death spiral. A lot of these institutions that went under should never have gone under. And it's not just banks, it's life insurance companies. Just look at the stocks. Prudential, MetLife, Hartford, Lincoln, smashed to pieces. In fact, Lincoln just yesterday escaped a huge bullet. Short sellers now know the bond maturities of every financial institution, every retailer, because they figure who is going to have a hard time refinancing that debt. And then they go for the jugular. That's what nearly happened to Lincoln yesterday. They've got another big date coming up in May when another loan is due. They're ready to pound these things into extinction. So this is artificial. This wasn't something systemic. This is something we allowed to happen. You should never have had those companies on the brink, life insurance companies, for crying out loud. So watch what the regulators now do with mark-to-market. Now that the Financial Accounting Standards Board made some reforms last week, watch how it's actually done in the real world. Watch what the SEC does tomorrow, and watch what the Federal Reserve does. If it starts to get more aggressive, and I suggested the other day, since President Obama loves Abraham Lincoln, one thing Lincoln did in the Civil War is generals didn't perform, he fired them. So I suggested he fire General Geithner, General Bernanke, and get somebody in who doesn't have the slows. And, Lincoln had that wonderful phrase about General McClellan, he has the slows. Well, Bernanke has the slows. Get somebody who will respond to the crisis and will pull out of it. And then we get to the big debates. Then we get to where the course of this country goes, because we will recover, and the question will become, how fast will we recover? How strong will this expansion be? And that gets to very basic questions, as Pete pointed out, on taxation, on spending. The big issue this year, the biggest one, I think, is health care. Will we start to nationalize health care? Big question. The administration is going to push hard on the idea of creating a government health insurance company, sort of Medicare for everybody. And they'll say it's to help the uninsured. And in doing so, they'll create this company. They'll charge rates in a way that'll hook in everyone from the private sector and in effect say to private health insurance companies, you play our game our way or you're going to go out of business. That's how they do it. They know with Hillary Clinton, you don't try to do it frontally, you try to get them on the sides, hit them on the flanks. So this is the big debate. And the response should be, look what you guys did to Fannie and Freddie. You're going to do that to what remains of health care. You want Barney Frank running your hospital. Thank you very much. Katrina and the Bush administration, you want that in health care? It's going to be a hard-fought battle. That's going to be the big one. Because if you lose on health care, it's going to be very hard to reverse it. We can lose these other battles and reverse them. But you lose it on a big one like health care, very, very hard to reverse. This is going to be the big one. There are going to be other big battles, but I think we're going to win them. On forced unionization, doing away with elections, the secret ballot on unionization, forced arbitration. One of the things they want to have in is that if you are unionized and you don't come in agreement with your union, the government will appoint an arbitrator who knows his bread is buttered by the unions and force a settlement on you. They'll tell you what your wage settlement will be, tell you what your contract will be for 2 years. Forced arbitration, big thing. But I think we can win that. The more people learn about it, the more they say, this is nuts, this is not right. And on energy, cap and trade, which is a nice way for massive taxation, I think we can win that. Public opinion's starting to turn. But health care is then going to be the big one. These other battles are important, but I think the tide is beginning to turn. But we really haven't engaged yet on health care. If we win that, prevent this nationalization, socialization of health care, get more free enterprise in health care where you control more of the money instead of third parties, will turn an area of the economy, in fact in the whole world, that is seen as a liability into a fantastic growth industry, just as we've had elsewhere. It can be done, and we can lead and show the world how it can be done. Talk about the ultimate freedom, getting healthcare to be seen as a boom industry, real productivity, like you have for LASIK surgery on the eyes, costs half of what it did in real terms 10 or 12 years ago. We can do that in the rest of healthcare. And by golly, what a blessing it would be for all of us. So longer term, got some real battles ahead. Stay a strong and stable dollar. The dollar should not be a plaything of anybody. It should be steady in value, something people can depend upon. The biggest mistake of the previous administration, again, it pains me to say it, the biggest mistake of the previous administration was its weak dollar policy. They did the wink and the nod when the dollar got weaker and weaker. They could have easily called the Fed. Treasury could have easily called the Fed behind the scenes and said, what are you guys doing? Back off from it. They could have stopped it. But they chose not to do so because they thought it would improve our trade balance. Talk about protectionism, currency protectionism. Dollar should be steady in value. Bill Clinton understood it. Bill Clinton understood that it was a weak dollar that helped do in Jimmy Carter, and he wasn't going to allow that to happen just for political reasons. This administration was the first since Jimmy Carter have a weak dollar policy. I hope the new administration, I don't see signs of it yet, that's why I want some new generals in there. You know, Mr. Geithner, I don't know where he'd go, but keep him out of Washington. And Mr. Bernanke came from my college, University, Princeton. Well, Princeton in the nation's service, as we like to say, bring him back, get him out of there. But strong and stable dollar. And then, as Pete touched on and Pierre touched upon, taxes. The thing to remember, and I'll close with this, and it sounds so simplistic to say it, I've said it, Pete has said it his whole life, is that taxes aren't just just a means of raising revenue for government, they're also a price and a burden. And that's why, you know, think of it this way. The tax you pay on income, price you pay for working. Tax on profits, price you pay for being successful. Tax on capital gains, the price you pay for taking risks that work out. Proposition's a very simple one. Lower the price of good things like productive work, risk-taking, success, you get more of them. Raise the price, you get less of them. Very basic, and that's why there's a difference between cutting tax rates and one-time rebates. Rebates are useless, nice to get the money, but it doesn't change incentives. It's out there, gone, done. Whereas tax rates, you lower them, you get good things again and again and again. Delaware's proved it time and time again. So I'd replace this tax code with a simple flat tax. Get rid of the 9 million word code. Last year, the IRS announced that we spent 7.5 billion hours filling out tax forms. We've amended the code 20,000 times since 1986. So why not just have a simple rate? I'd propose 17%. Generous deductions for adults and for children, first $46,000 free of federal income tax. Only 17 cents on the dollar above $46,000. No tax on savings. No death taxes. I believe you should leave the world unmolested by the IRS. As our founders would say, no taxation without respiration. And you do something like that, and all this misery we're going through now, this crisis, will be quickly forgotten. We'll remember it as an historic artifact, not as something that has scarred us for years and years and generations, the way that did happen with the Great Depression. We can turn this thing around. It was not systemic that brought it about. It was several catastrophic errors made on the monetary side. We correct those, and then we do right on things like health care and taxes and a strong and stable dollar. And we'll meet again. And Pete will have to have even more awards, because suddenly he'll find that people see the light. And he's going to have so many people to choose from that he's going to hit you up and say, we got to give out 10 of these things instead of one. Thank you all very, very much.